Hello guys, and welcome back to the other video, then chapter 3, the part 3 of this ongoing series. And I'm going to try my best to upload all the 6 videos before your October-November exams, as I'm hoping to do so. But yeah, that's the plan for now, but I'm hoping I'm going to stick to that. So far I'm hopefully going on the right track. Anyway, in today's video, today's chapter, we're going to be having a look at microeconomic decision makers. I believe in the chapter 2, in the end, I basically talked about what exactly is going to come into this chapter. What are we going to be talking about in this chapter and everything that revolves around this chapter. So from the, just to give you a quick, quick introduction, quick, what do you call it? Insight to what we're going to be learning in today's chapter is decision makers. In a microeconomics, which is simply an economy, right? Economy. Who are these decision makers and how are they affected, right? How do these decision makers basically affect this microeconomics, this economy actually, not even microeconomics, right? Microeconomics is a part of economics where we just talk about producers and consumers, and they are decision makers. These producers and consumers, we're going to go now further. We're not just going to call them producers and consumers. We're going to go further, right? Under producers, we have workers. Under consumers, we have households. Between these two, we have something called money, which we're going to start off by talking about. Between those two, we have something called banks. Between producers, between workers, we have something called trade unions. So now, we're not going to call these people in our economy producers and consumers, but rather we're going to now go deep into these two segments and talk more about that. Like in every video, I think this is tradition now. Economics is like a hierarchy system. It's like I don't know, is that the right word? Did I use the right word? I don't know if I used the right word. But economics is it's like steps, right? So we have economics here. Okay, come down to economics. What do we have? 1 second. So we have economics, let's say. Okay, so the first part we have economics. We go down the chain. We have micro. And we have macro. We go down the chain again. From micro, we have something called producers. And we have consumers. Okay? And then from the macro, we have the government. Right? And like that, economics just spreads apart. From the producers, we have workers. From the consumers, we have households and different decisions. From the government, we have different policies. We have 3 policies that we're going to be learning later. The fiscal policy, monetary policy, right? Supply side policy. Everything split. Advantage, disadvantage, split. Features, features, that gets split. So everything in economics is like a system. And the reason why I mention this in every video is because when we write our answers in that final exam, we're going to be thinking of this chain that I've been mentioning in every video. When I want to answer a question, I'm thinking of it as a chain, and that's the best way to answer any economics question, is because everything is linked from the other thing. If you have noticed, in every video, I've said something that relates to the previous video. Literally, I started this video by saying that I've mentioned about this chapter in the previous chapter. So I'm not going to waste a lot of time, but you get what I mean. This is very important. This is not part of what we're going to learn in this chapter, but this is part of what we're going to learn in this entire course, right? And that's what we call some sort of basically we're learning the whole system as a whole, right? So yeah, enough of yapping. Let me just quickly actually now talk about what this thing is actually. Okay, where did it go away? Okay, let's put that back on the screen, and now let's get on with this topic right here. Okay, and I'm going to start off with the first topic now. This chapter is pretty big. I think might be the biggest one. I'm not sure. That's why I don't want to waste a lot of time, right? I want you to finish this chapter, go to the next chapter, finish that chapter, go to the next chapter, finish all 6 chapters, and get ready for this exam. So I'm not going to waste your time with, do this structure, do that structure. And by me saying this, I'm wasting your time. So let's get on with the first subtopic, and that is money and banking. Okay. I'm hoping that introduction was not so bad because I really tried. I tried to make it fun, but I think now that I'm hearing myself, I don't think it sounded fun. Um, but basically, I just wanted to say that everything in economics is linked, and therefore, we talked about producers and consumers, and now we link all these subtopics to that. Okay, that's basically what I was trying to say. Okay, let's start off with the first subtopic of this entire chapter. I don't know how many times I've said that, but I want to just get into this. Okay, now, like tradition, like how I always introduce every topic, we look at the words in the topic and we now think about everything, right? Because economics is a lot of stuff that's already revolving around our lives, so we should already know about this. For example, in this title here, in this title, we say what money is. What is money, right? Money is something that allows me to buy everything, right? It's something to buy me this object, that. That's what money can do, right? So what is money? And now, after I wish this was a classroom where I would ask, what is money to you? What is money to you? But apparently I'm talking to myself, and that is sad reality, but I'm talking to myself. And now I'm just going to answer myself by saying, what is money? Money is simply something that I trade with goods, right? It's something that has value and gives me value back, right? I'm exchanging something, value for value, right? So that is what money is. And in economics, what money is called is simply this. Money is a medium of exchange of goods and services, just like what I try to explain right now, where it's a medium where it's exchanging goods and services, okay? So that is what money is. Now, why do we need money, right? And I'm not going to bore you with, oh, you need money for this, you need money for that, the economic stuff. You already know why we need money, no? We need money so that we can exchange these goods and services. And if we don't have money, we will have no motive to produce anything. Simple. Let's move on. Okay? I don't want to waste your time, right? Because a lot of this chapter is general knowledge. So something like, why do we need money? Seriously? Ask yourself, why do we need money? Okay? If you can't answer yourself, then I want you to drop the... Okay, I'm kidding. Okay, so why do we need money? Let's look at the economics definition again, because I have to. I'm going to go through every part of the notes, but I'm not going to waste a lot of time towards this. But simply, money is a sense of motive so that we can keep producing something, right? So we can't produce all our wants by ourselves. Thus, we need something by exchange. So this is what's giving the exchange, because I cannot produce everything I want in this world. Like, can I make a car if I want to? No. So therefore, I want other people to make a car for me, and then I'm going to give them money so I can have that car. Okay, that is how this entire system works. Right, other people, everyone, big community joins together, and since I don't have those set of skills, I'm going to pay you for those set of skills. Okay, and in fact, in the past, they used something called the barter system, and this is kind of borrowed from that. But in that one, I believe they used to I believe, don't quote me, but they used to trade on just like goods. Like if I have like a table and then I'm going to exchange it with a chair, right? That's what barter trade was. And the problem with barter trade is that some goods are not portable, some goods were not durable, and there was no way to give it a value. Like, oh, why is this a fair trade between the two, right? So yeah, that's what barter trade was. Okay. Now, we're going to start off this topic by the first thing, and that is why we use money, right? Why do we use money? Why do we not do barter trade? And we use money because of the following. Number one, why do we use money? Why do we use money? Okay. Let's start off with the first one. The first reason why we use money is because it's durable. Okay, money is durable. It doesn't tear. It doesn't, when it's rained upon, it doesn't get wet, right? It doesn't lose color. It's durable. Second of all, it is divisible, right? If I have some certain price that I'm paying for this, I can divide it into equal parts and get whatever I want. Third of all, it is portable, right? It's not heavy. Okay. Next, let's look at the next one. The next one, it is generally accepted, right? Everyone accepts money. It is generally accepted. Okay, that is the next reason. Okay, so that is the reason why we use money. Okay, we use money for the following reasons. It's durable, it's divisible, it's portable, and it's generally accepted. And these are the characteristics of money. So these are the characteristics of money. Okay, these are the characteristics of money. Okay, let's now move on to the functions of money. When we think of it, let's talk about the functions of money now. Okay, and this topic is not that big because it's kind of just general knowledge, like just talking about what is this, what is that. So let's now have a look at the functions of money. Okay, so the functions of money. Okay, when we talk about the functions of money, what do we talk about? Okay, let's start off with the first one. The first one is that money is a medium of exchange. As explained above, self-explanatory, it's not that difficult. I have money and it's gonna help me exchange stuff, right? That's what money is. Secondly, money is a measure of value. What does that mean? Money has a value and I can use that value to purchase stuff, goods and stuff. So money is a measure of value. Very important to remember these functions of the money. They do ask you the different functions, so you do need to know all these definitions, by the way. All these functions, all these characteristics, you need to remember them. I just don't write them for the purpose of writing them. I actually write them because I want you to remember them. Okay, next one is money is a store of value. That means that the value holds, and of course over time it keeps changing, but that doesn't matter for now, right? Money is a store of value. It has a value that is stored. It holds a value for a long time, allows us to save it, right? It's not like, oh, your money has a time limit of 5 minutes or okay, 5 minutes was a bit dumb, or like of 1 year, and then your money gets expired or something like that, right? It has, like in barter trade, let's say I had a food item, and then if I have that food item, it expires in 1 year, right? Is it really value, right? So in this case, money has value for a very long time. Of course, this value keeps changing slightly from time to time, but it has a fixed value, right? And it only after a long time does the value actually affect. And finally, is the value money is a means of deferred payment. What does this mean? Deferred payments are basically purchases on credit. So it's when I can decide, okay, I want to pay later. Give me the good, I want to pay later, and I can do that with money. Right? I can do that with money. So these are the 4 functions that involve within money. So we have medium of exchange, measure of value, store of value, deferred payment. Okay, so these are the 4 values of money. Okay, I'm hoping that is clear, and that is pretty straightforward. So far we've just had a look at money, right? And stuff that's kind of general knowledge. I don't think you've sort of had any problems so far. I'm just been talking about money, what money involves, functions of money, characteristics of money. Let's now move on to something called banking. So banking, and as you already know, banking is what gives us this money, but I'm gonna still have to talk about it because it's in your syllabus, right? But a lot of this like subtopic is actually general knowledge. Okay, I'm gonna stop saying that now, sorry. Okay, but banking. Banks are financial institutions that they basically act as intermediaries between borrowers and savers. Okay, so there are people who borrow from the bank and there's people who save at the bank. Okay, and these guys are the middle ground. Okay, so the money that we save at the banks are actually given out to people who want to borrow, and that's how it kind of works. It's like in between. Now we have 2 types of banks that we need to know in this, and we need to also know the differences, I believe. And that is the commercial bank. So that's the first one here. We have the commercial banks. And the second one we need to know is the central bank. So central bank here. Okay, so we have the central bank. So we have the commercial bank and we have the central bank. Okay, let me just remove that one. What? Okay. So we have commercial banks and we have central banks. Let's now look at the 2 functions of of both of them, right? So we're gonna have a look at the functions of the commercial bank and then the functions of the central bank. So let's kind of like split it among the 2. Okay. So we'll put central bank here and then commercial bank there. Okay. So I'll just copy everything at once and just paste everything as once here. So this is everything for commercial banks. So let's look at each of one of them one by one. Okay. So this is for commercial banks. Let's talk about commercial banks. What are commercial banks? Commercial banks are simply banks that have many branches among the city, right? And the central bank is the one that monitors all the commercial banks. Okay, so the commercial banks are the ones that are spread out within the city. A central bank is the one that manages all the banks. Okay, that is what we call. Well, that's what's kind of the difference, and that's kind of how we can understand what they mean. So when we talk about commercial banks, or when we are talking about just commercial banks, let's look at the functions, right? First of all, it accepts and deposits in forms of savings. So accept deposits in forms of savings. If I give something out, I want you to save it in the bank. It then helps customers. So how I think of this is just think of a bank, right? Just go to the bank. What happens in the bank, right? I'm allowing deposits for savings. I'm allowing you to make and receive payments via other bank accounts or via their bank accounts. It gives me loans to businesses and the private individuals. It helps me buy shares. It provides insurance in any type of money type theft or anything like that. It gives us exchange foreign currencies, and it provides financial planning. There's not much I can actually explain in this, but rather this is something that you have to do, and you need to memorize all these points and also the next one, right? So both the functions. A lot of economics is sadly cramming or memorizing, if you don't know what cramming means, but memorizing. So yeah, I guess there's not much, because most of these points are kind of you already should know what they mean. And yeah, you just have to memorize them. And the best way to put yourself to remember this is go inside a bank and think you're inside a commercial bank in those cities. What are the stuff I can do in these banks? Okay, and that's how you can probably remember. Let's move on to the central bank. Maybe some people might not know a lot about this, but the central bank is the big boss, right? It does everything. It handles everything. Okay, and that's the central bank actually. Okay, so the central bank will issue the notes and the coins in the national currency. So these are the ones that actually give the notes to these banks, to these commercial banks. Okay, it manages all payments relating to the government, so all the decisions made by the country by a whole, okay, is actually decided by the central bank. Okay, it also manages something called national debt. So if I'm taking out loans, there's that, again, central bank, right? And there's a lot of other points. Max, you need to memorize 5, but what they usually say is like, okay, even 4 it works, 5 to be safe. What is the best way they usually say is that cram 10 so that during the exam you remember 5. Okay, so, or 7, you remember 7. Okay, so that's why there are many points, but a lot of the points is like stuff like it manages countries' goals, foreign currency reserves. It's the last resort. That means that if the commercial banks have no money, they're going to ask to the central bank. It's the big boss, basically, right? It also controls all the other banks, okay? And the rest is just kind of self-explanatory, and I don't like saying that because I'm trying to teach a topic, but a lot of this is in fact just, you have to read it and you understand yourself, because it's not anything that I can explain, right? Like something like it controls other banks. Like what can I say about that, right? So look over these points and memorize them. A lot of times they do ask the differences between them, or they do ask questions related to them. So you need to know. You need to know about these things. Okay. Now let's move on to the next subtopic. So that's all about money and banking, right? We talked about money. We talked about banking. That's kind of it. That's kind of all that we have to talk about this. And another smaller subtopic within this is something that we call households, right? So let's now introduce what households are. Okay, let's introduce what households are. Now, again, like normal tradition, I'm going to start off. What does households mean, right? When we think of households, what does that mean? Again, sad part is I have to answer it, but households is when I'm just looking at the consumer, right? I'm just looking at my activities, right? So that would be my income. What is my expenditures? What are my consumptions? What are my wants? What are my needs? What is my opportunity cost? Okay, anything that relates to me is what households are. Okay, but the two main things that should stand out is what am I spending? How much am I saving? How much am I borrowing? Those are the 3 key factors. Okay, what am I saving? What am I borrowing? And what am I spending? And we're going to look at each of these three individually. So let's start off with spending, which is the same thing as consumption, right? When I spend something, I'm consuming a type of product, not necessarily a product or even a service, right? Okay, that's just in economics terms, right? I can't be consuming a product that I bought. That, like, I can't. If I bought a table, I'm not consuming that. But since I'm a consumer, I'm spending on that, and I'm consuming what the table can do for me, right? I don't know if that made sense, but yeah, I don't know. Something's up with me today. But anyway, now, okay, spending, consumption, right? When I buy something, I'm consuming something, right? I think that's clear. I've said that a couple of times. So why do I first of all spend, right? Basic. This is chapter 1. Why do I spend? I spend because I want needs and I have wants. So I'm going to spend stuff, right? I have my wants and I want to buy this, and I'm going to spend money on this because I am earning for a reason, right? I want to spend. Okay, so that is what we mean by consumptions. Now, what we look at between all the three things that we're going to be talking about in households, we're going to be saying what are the factors. Okay, we're going to look at the factors that affect all of these. Okay, when I'm spending, what are the factors that affect spending? And there are 4 factors that you need to look at when I am buying something or when I'm consuming something. And these are the 4 factors that we look at. Let's look at each one of them one by one. The first one is the disposable income. Okay, if I'm rich, this is kind of similar to demand if you think of it. If I'm very rich, that means I can spend more. Simple, right? The more income I have, the more people will someone consume. Is this done? Done. Let's look at wealth now. Wealth. What's the difference between wealth and income? The more wealthy. Now, wealthy includes property, jewels, company shares. It doesn't mean I have the income, right? Of course, the income is what gives me the wealth, if you think of it like that. But income, let's say I don't have the money yet, but because it's a disposable income, that means that I know by the end of the month I'm going to get this much amount, so I'm going to spend more. Wealth is when I have enough properties, jewels, assets, shares, so then I can spend more. Done. Consumer confidence. What's consumer confidence? If I know my job is stable, if I know my future income is going to keep coming, right? If I am certain that I have saved enough and I can spend now, then I'm going to spend more. Done. If I have enough savings, I'm going to spend more, right? This could be an easy way to think of it like that. Interest rates is the next factor. Now, if interest rates provided by the bank are high, what does that mean? If interest rates are high, that means I have to pay more back to the bank, right? Interest rates are simply, okay, for those people who don't understand, I think a lot of people must be already knowing, but I'm going to quickly just explain for those people who don't know. But when I give money to the bank, okay, when I'm borrowing money from the bank, of course they want me to return it, but how does the bank business of me? How does the bank profit of me? So when I borrow that money, they expect me to give this much percent back to them, more than the amount. That is what interest rates are. So if this giving back more or the interest rate is higher, then I'm not going to borrow that much. I'm going to rather ask my family, friends, or someone to get me the money, right? So if interest rates are high, then I'm going to save more, because when interest rates are high and you save, that means that the interest on the saving is also high. That means the bank gives you that much interest rate. Of course, it's different, but you get the point, right? So the interest rates is a big thing. So depending on the interest rates, I'm going to spend or save. Okay, so done these. Talked about the first one. Let's move on to savings now. Okay, let's start off by defining what savings are. What is saving? Saving, come on, right? Opposite of spending. I am not spending, I'm saving, boss. Okay, let's look at the factors now. So it's as simple as that. Okay, let's look at the factors now. Okay, let's look at the factors now. When looking at the factors here, they look like there's so much going on, but trust me, it's not. Let's start off with the first one. Saving for consumption. What this means is that sometimes if I want to buy a car, I'm going to save. And then once I have enough money, I can buy a big purchase. So therefore, I am saving. That's a factor. Second one is disposable income. So if my income is not that high, then it depends actually. If I have a high income, people with higher income are more likely to save because they have spare money that they can save. Thus, richer people have more incomes, so therefore they have money that they can save on. So of course, that's a factor on saving. Next is interest rates. Of course, just like the other one, if there's high interest rates, then I'm going to save. Simple, right? Interest is the return on saving, and the longer you save, the more the higher the amount you get back because of the interest. Then it's consumer confidence. Let's say that I'm not confident about what happens to my job 2 years down the line. I'm going to start saving from now so that 2 years down the line I have money. Done. Availability of saving schemes. What does this mean? Is banks can offer good schemes, very demanding skills or schemes. And if it's demanding to me, then I'm going to start saving. So if there's like a new package and it's very like thrilling and exciting for me, then I'm going to save. So there you go. That's saving. Let's go to the next one, borrowing. Okay, you can see a lot of these are like also repetitive. That's why I'm not spending that much time. So what's borrowing? When you think of borrowing, okay, when we think of borrowing, what's borrowing? Borrowing is just getting from the bank, right? I'm not going to waste time again there. Let's look at the factors and we look at that now. Okay, here it is. So this is borrowing now. Factors that affect borrowing. Okay, let's look at it. Interest rates, number one. Again, same thing like that. We look at interest rates. So if this interest rate is low, then I'm going to borrow because I have to pay back less. Done. Wealth and income. Let's say if I am very rich, then the bank knows I will pay back. So the bank is willing to give me money. Okay, they know I'm going to repay a loan. Okay, so therefore they're going to let me borrow more. So the people who are rich, again, they kind of are borrowing more. If you have noticed, the trend is the rich people are getting a lot of benefits from this. Consumer confidence. Let's say in the future, something will happen to their financial situation that they won't be able to borrow. For example, maybe they are something's happening, right? The price will rise, inflation will happen. Later on, we'll discuss what inflation is, but something can happen, right? And that's going to make me borrow right now, maybe, okay? Now, there's ways of borrowing as well, right? I can borrow from bank loans. I can borrow from overdrafts, okay? I can borrow through credit card payments. I can borrow through a lot of ways. So there's different factors and these are the different ways, and the ones that entice me, I'm going to use that, okay? And that is simply what we talk about, right? So this is what households talks about: spending, saving, and borrowing. So that's it for this subtopic. Let's go to the next subtopic. The next subtopic is on workers. So this is now a bigger topic, a more topic that that we have to kind of look at now. So workers, when we talk about workers, let's look at that. So let me put that here. Okay, let's talk about workers now. Okay. So when we talk about workers, what are we talking about here? Now, we know from chapter 1, when we talk about workers, we talk about something called labor. Okay, we talk about something called labor. So this whole chapter is actually just involving what labor is. Okay, so we're talking about when talking about labor, what is the relationship between the workers and stuff in the labor. So we'll start off this topic by simply stating what exactly happens in the labor market, and that's what this entire topic is about. And we just talk about the labor market. Okay, so everything that happens in the labor market, what are laborers, and everything from that. Okay, so first of all, laborers are someone who work. Okay, they work for a business, and these people, they need wages because of course they're working for your business. So I need a wage, okay, so that I can satisfy my wants and needs, right, as the worker, as the consumer, because those workers can act as consumers as well once they are outside the business place. Okay, so they need a form of payment, and we say these types of payments, or the payment for laborers, so the payment for these people are actually wages. Okay, so we're gonna now talk about that. So let's talk about the payments for labor. Let's talk about the payments for labor. Now, you might think this is direct, right? Just pay them money. But it's actually different, because in the real-time world, there's a different ways people are paid, in different ways, okay? So first of all, stuff like I am paid per hour, I am paid per how much I sell, I am paid on a base of a salary, I am paid based on my performance, so on and so forth. Commission based. Those are the different types of payments for labor, and that's what we're going to have to talk about right now. So let's start off with the first type of payment, which is the one that's more obvious, and that one is the per hour one, right? So a lot of people, if you see that, they give their jobs in per hour. I am paying you this much per hour. So this is called the time rate wage. So this is going to be the first type of way I pay my labor. So a way to think of it is like, let's say I want more money. I can start doing overtime wages, which means I do extra hours just in order to get paid more. Okay, so simply, now that again depends on the business. Some businesses allow only certain times where you can work, but some businesses that work 24/7, they say, okay, you want to work 24/7, I'm going to allow you to work 24/7, and simply how many hours have you worked, and I'm going to give you that much money. Okay, so let's say they give you like $10 per hour. So if I, of course, want more money, I will work more hours, and that's as simple as that. Okay, so that's how the payments work for per hour. Let's look at the next one. The next one is actually piece rate wage, which means depending on how much output is produced, I will pay you according to that. Now, in a lot of businesses which involve like selling, let's say electronics, selling, I don't know, anything that's a good, the wage is dependent on that. So let's say maybe for an electronics store, months like Christmas and stuff like that, where you get paid more than usual, right? So those times of the month, you get paid more, right? So depending on how much output has been produced, okay, or in this case, if let's say it depends on how much output the employer can make. Let's say it's a business and you are packaging bottles. Now, everyone in this company, they're told to sit aside. They get a big stack of bottles and they're told to package these bottles by hand. Let's say this money that you make is dependent on the bottles. So the more bottles you produce or the more bottles that you can make, the more money you earn. Okay, that's simply what it means by that. Let's go to salary now. This is, of course, the one that everybody knows about. This is the one that's kind of standard for a lot of jobs. A salary is simply a fixed payment, right? It's a fixed payment that's paid per month, depending or regardless of how much output, and there's fixed hours that you just have to do, right? So monthly payments are made to workers, managers, office staff, and they run non-manual jobs. That means they have to sit in the computer, do monitoring of this, that, and they have to do it per day for this many amount of hours, fixed hours, and they get paid at the end of the month. That is what a salary is. I think you should already know this. Again, I told you a lot of this topic is general knowledge. I'm going to stop saying that. Okay, that's the last time I'm going to say that, but I'm just constantly trying to remind you that a lot of this actually is stuff that you should already know, but I'm going to still explain it for those people who don't know, because of course there are people maybe who might not know this. And of course, this is for you going through the syllabus, because that's the purpose of this video. Okay, the next type of payment is the performance related payments. What does that mean? So performance related payments is stuff like, okay, let's see, you performed better for our company, meaning maybe you sold more items in our company. Let's say I have a retail store, right? And this is a very good example, right? Like, let's say I have a Nike store, okay? And if you've noticed, a lot of the workers at Nike stores, they always talk to customers, and if the customer buys something from them, that means their performance is high. Okay, that not necessarily means that they will be paid higher or more, but that might mean or could be a reason why they actually want customers who pay who basically, I give them the shoes to wear. I tell them this is good, and then at the end when they buy something, they bought something maybe because of me, right? So I get a bit of credit, I get a bit of percentage of that, and maybe in my salary I'll get more because I did that, right? Because I sold more items, as simple as that. So that depending on my performance. The last one is something called commission based, and this is usually not like a proper type of job, but a lot of jobs just revolve around commissions, which simply means a commission is something whereby if I'm selling something, if one of the consumers buys that product, I'm going to get a percentage of that because I kind of help them sell it. So that's what commissions mean. Okay, so these are the 5 types of payments for labor that we talk about. And yeah, so those are the 5 payments for labor. Let's move on to the next part of this. And the next part of this is actually what affects someone's choice of occupation. Like, Why should I work here? Why should I not work here? That's very important for wages. And you might ask yourself, why are we learning this? How is this related to an economy? And this is actually very important because the government uses this information to decide its regulations, decide its rules, and a lot of other stuff that the government decides using these policies as a whole. Okay, so first things first is the first thing, like let's say what this question means is that let's say I am looking for a job. Okay, I am looking for a job. What are the things I look at, or what are the things I consider when I'm getting this occupation or when I'm getting the job? And the first biggest factor is the wage factors, meaning money related factors. So wage factors are money related factors, and here is the stuff that when I talk about wage factors, what I mean. So the wage conditions of a job, such as the pay rate, the performance related payments, the bonuses, those are all called wage factors, right? How many hours do I have to work to get this much money? How much money am I getting per hour? Those are basically the wage factors. In fact, that's called the pay rate, right? The pay rate is how much money I'm getting per hour, let's say. Okay, so those are the wage factors. Let's have a look at the non-wage factors, and there's quite a lot of non-wage factors. Now, you are supposed to cram all of this, which is bad, but you're supposed to cram all of this because they can ask you, name the non-wage factors, name the wage factors, right? In fact, I remember back when I did my IGCSE exam a while back ago, I got this question, right? And the way I answered it was just through general knowledge, okay? Because when I'm looking at a job, right, and what are the stuff I'm looking at, and it eventually, I think it was maybe my mock exam or something like that. Of course, the finals, I had to memorize everything, but I think it was a mock exam or a test or something like that. I really remember this question. It said, state two non-wage, state two factors that affect occupation or labor or something like that. It might be in a past paper, you might find it there. So that's when I just I thought of just, what do I look at, right? And these are all the non-wage factors. So let's have a look at them. So first of all is hours of work. This is kind of a wage factor, but okay, number of hours of work is different. Okay, pay rate and number of hours working is different. Okay, so hours of working is different. Okay, holiday entitlements, that means professions like a teacher. So I will have more holidays as a teacher. So is that a big factor for me? Then I'll be a teacher, right? Some jobs like in the army and stuff, you don't get holidays. So is that a factor? Promotion prospects. Let's say I start to be one position and I want to level myself up. Is that a big thing for me, right? So I'm going to look at that as well. Then it's stuff like quality of working environment. So quality of working environment. So that's where I want to work. Like, let's say I'm a miner or something. Do I like that environment? Am I working in a factory? There's smoke and stuff like that, right? That's also a big thing to look at, right? Okay. Yeah. So now, okay, let's move on, right? The next one is, so that one's done. Job security, right? Is it how long of a plan is it? So on and so forth. Medical insurance, training opportunities, distance from the workplace, and so on so forth. Okay, so those are all the non-wage factors that we look at, and yeah, those are some stuff that affects the occupation whenever I'm deciding if I want to work or not. Now, something to talk about here is a bit aside from the topic of just factors and features and stuff. We need to talk about something called labor demand. Okay, this might be confusing, and so I'm going to try to explain it properly. Now, what is labor demand? Labor demand is the number of workers that is demanded by firms at a given wage rate. Okay, so the number of workers demanded by firms at a given wage rate. This is called labor demand. For example, a business charges $10 per hour. What's the demand of these laborers or the workers at $10, supposed to as, let's say, $20, or supposed to let's say at $50? Of course, at $50, the demand is going to be very high, right? Because, of course, the higher the price, the higher, in this case, it's not the law of demand, but if I'm getting paid more, then I probably want that job, right? So the higher the demand for the product also, the more labor producers will demand, okay? So here we say something called labor producers. Okay, let's say there's a certain product that has a lot of demand. If that product has a lot of demand, then I want to have a lot of supply. And in order to have a lot of supply, that means I should have a lot of producers. Okay, and a correlation that what this was is that if wages increase, right, if wages increase, then the demand for labor increases. The demand for labor will contract, right, or increase. Basically, demand for labor increases. Okay, now labor supply, labor demand is that, right? So it's the workers demanded by firms at a given wage rate. Now labor supply is the number of workers available and ready to work in an industry at a given wage rate. Okay, so when the wage rate increases, the supply at a given wage, when the wage rate increases, the supply of labor extends. Okay, sorry, what I just explained was labor of supply. What I just talked about. Let me explain what labor of demand is. Labor of demand is the number of workers demanded by firms. Number of workers demanded by firms. Okay, there's a big difference. Okay, now when I'm looking at in the perspective of firms, let's say if a product is in so much demand, is in demand. If a product is in demand, then I want to produce that. No, if I want to produce that because that product is in demand, we are looking at that aspect of labor demand. So labor demand is the higher the demand for some type of product, the more labor producers will demand. Okay, and when we talk about labor supply, we're simply just talking about the workers. What I explained above in this case, right? Depending on the wage rate, what's the labor supply? Okay, there's a big difference between labor demand, labor supply. So labor demand depends on the labor of the product, and if the product is in so much demand, that means that is labor demand, meaning I want workers to work for me because I want to produce that good, right? Because of course supply has to rise in order to match the demand. And labor supply is how much workers are willing to actually is how much workers are willing to basically work with me, right, at that given wage rate. Okay, now there's a graph here that will help us understand what I'm trying to talk about very easily. And this is the graph. Okay, this is the graph here. Now in this graph, as you can see, might be confusing at first, but we'll analyze it. As you can see, as the number of hours work, there's a sudden backward wage rate. Why does that happen? Okay, there suddenly is, it goes down like that. It goes rise, and then goes like that. Now the reason to this is it's called a backward bending supply curve, right? It's a backward bending labor supply curve. Okay, so when a person gets to a very high position on the wage rate, the number of hours may decrease, right? You know this, right? Now this is how the labor or the wage per hour curve works. Okay, where this is the wage rate, of course, and you can see it's rising as the number of hours are going up, as you can see, right? So this is how that curve looks like. Okay, and this is called a backward bending labor supply curve. Okay, yeah. And the reason why there's this bend is because when you get a certain wage rate, okay, once you reach a certain wage rate on the number of hours worked, right, like CEOs, executives, those types of people, they have a supply like this, a bend. Why? Because once you get a very high position, the wages and salaries increase very high. Okay, so wages are very high, but that does not mean that the hours are very high, right? That is why it's a backwards bending curve, because the hours does not have a proper correlation with wage rate. Okay, it does not mean that the more hours I work, the more money I make. CEOs might work less than how much workers make, but they still earn the most. And that is why it's a backward bending curve, because not for everyone it's actually like this. Okay, so that's the reason why it's a backward bending curve. And yeah, that's basically explains why there's this curve, and I'm hoping that's good to you. Let's now have a look at the factors that shift in the labor demand curve, and then factors that cause a shift in the labor supply curve. There's a difference, right? And if you didn't understand what labor demand is in the previous slide, then you might understand it from here. But I'll try to explain it again, and it was a mistake I made also. I kind of mixed it up. I explained labor supply first. But labor demand depends on, so if product is in demand, I want the labor in demand. What's the labor in demand because of that product? Okay. So of course, one of the factors is of course the consumer demand on the product, right? Because I literally am using that in my definition. So depending on the product's demand, it's going to affect my labor demand curve. So the consumer demand for goods and services will of course depend on the labor demand curve. Okay. As in it's going to have a factor or cause in the labor demand curve. The next one is the productivity of labor. Let's say I'm very productive. If I'm very productive, then that means there will be more demand for labor. Do you guys know what this is trying to mean? It's the demand for the labor. Okay? And labor supply, it's the demand to want to supply, kind of like that, right? Like I want to supply, but what are this? Because it's not always do I want to work at some type of rate, at a given wage. So labor demand simply means what is the demand for the labor, right? The demand for the labor, right? So if this labor or the workers in general are very productive, then I want to hire more labor. The next one is the price and productivity of capital. Now, whenever we talk about labor, we talk about capital because capital is the alternate of labor. Okay, capital means machinery and stuff like that. So when we're talking about labor and when we're talking about capital, capital is a substitute, as it says here, because capital can be more productive. For example, machines can work 24/7, but laborers or labor cannot work 24/7, right? So price and productivity of capital matter. Okay, so the price and the productivity of the capital do matter a lot. Okay, so if the price of the capital were to lower and its productivity to rise, then firms will demand more of the capital and the labor demand will fall. Okay, so that's just how it works. Okay, let's look at the factors now that affect labor supply curve. And this is kind of very similar to the factors that we talked above. But it's like, what are the stuff I'm looking at? Okay, and the first one, let's go to another page actually. Probably will be better. Okay. And let's start with the first one. And the first one is the advantages of an occupation. Okay, it's the advantages of an occupation. Now, let's say, okay, there's different advantages to a job, right? For example, here they say that the number of working hours in an airline increases, right? Working hours is very high for airlines, right? They're long flights. So there's different advantages. Okay, so let's say I have less hours and good pay. What will happen to the labor supply? Can someone tell me that? Again, I have to answer myself, sadly. But what happens is that it's going to be in demand because I'm working less hours or less tedious hours and I'm getting a good pay. So that could be in demand. Another one is like, for example, work for home. Let's say that job is work for home and is giving me a good pay. I'm going to work for it, right? The next one is the availability of education and training, right? So if I have the required skills and stuff, if I have the education, if I have the training for that, if let's say pilots are lacking, then the labor supply for it will be low, right? And only once when the education and training institutes open, the labor supply will rise because I should have the necessary skills. Okay, I should have the necessary skills to become that pilot if I want to become that pilot. Okay, I'm hoping that makes sense. Okay, and the last one is something called demographic changes, which means the size and the age of the structure in the economy. Let's say if people are very young in my population, then that will mean I want to work more because young people work more, right? Because many young people, meaning can work for longer. If I have very old people who are close to retirement age, then they're probably not gonna work. Okay, now there's one question I want to ask. Why does someone's wage rate increase over time? Okay, leave economics on the side. Why does it increase over time? Okay, you can pause this video if you want to. Think about this if you want to. Why do you think it rises over time? It's not that hard. It's not a tricky question. It's not that hard. Why does it rise over time? And I'm going to answer it. Okay, it rises over time because of my experience. My experience rises. I become more efficient, right? When I get more skills, I get stuff like more efficient skills, right? And that is why over time I get paid more. That is why sometimes the older guys, like 40s, I don't know if that's old, that's not old, but older than younger people, they do get paid more. Okay, so that's actually what we talk about. We now have to talk about another topic here, and this topic is called wage differentials. So now we're going to talk about something called wage differentials. Okay, what are wage differentials? Wage differentials, coming from the name, differentials means difference, and wage is wage. So why is there a difference in wages? See what I did there? Very smart of me. And let's quickly go over all of them. Okay, so the first one would be this one right here. So the different abilities and qualifications. Okay, so that's why there could be a difference in the wages, right? And also previously when I asked that question, when I said, why does wages increase over time or with age? And this is actually a reason, right? So different abilities and qualifications. When a job requires more skills, that's probably means higher pay rate, right? Or for example, doctors, where there's an alarm. Okay, anyway, so when there is a high pay rate, I'm hoping that's not that loud because it's very loud for me. Looks like okay, anyway, so high pay rate, I don't know if I should cut that in the video. I'm just going to put it in the video because why not? Okay, so high pay rate. So when there's a high pay rate, of course, when you have more demanding skills, for example, like during COVID-19, the doctors had a lot of demand for just in general because they were more in demand, you know why. So therefore their pay rate was higher, or I don't know if it's higher, but at least it was more in demand. So skills or jobs or occupations that have more demand in the market generally, or have a lot of skills that are needed involves, or qualifications, because doctors have to study for a lot of time, for a long period of years. So therefore their return is of course a higher wage. The next one of the factors on why different wages are there is in fact the risk involved in the job. So for example, let's see, I'm thinking of a high risk type of job. For example, yes, rescue operation teams or people from the army or something, maybe they get paid more. Now I don't know actually the statistics if they're actually paid more, but like if the job involves something that's risky, right? So operation teams, right, they will have a higher wage rate because they are taking risks, they're risking their lives in order to do that certain service or do that certain job. So therefore the wages are more on stake. Or the I was trying to make a pun but it didn't make. Okay, so yeah, so the wages are more for those types of people. Okay, we move on and we talk about unsociable hours. What does that mean? So for those jobs that have night shifts, for those jobs that you have to work absurd amount of time, for those at weird times, for example, like at 2-3 a.m. You are let's say at the airport and you're working at 4-5 a.m. Those jobs, not a must. Again, not all these factors have like are always true, like not a must that just because I work at 4 a.m. I'm gonna have a high pay rate, but I'd say like there's kind of a correlation, right? So unsociable hours are one other factor of why of a reason to why maybe the wage could be different. So if I work at very night times, maybe I can get paid more. The next one is the lack of information about jobs and wages. Many times people don't know about what the actual wage is supposed to be for their job, and they just don't ever change it and they just stick to that. And even though they're being paid less, they don't even know about it. So maybe that's why there could be a difference in wage. Maybe same profession, same everything, but lack of awareness could actually be a reason why you might not be paid enough. And then there's something called fringe benefits, and I'll talk about that right now. Fringe benefits are stuff that are tied with your job. And I don't know if later on we look at examples of fringe benefits. Maybe we do. If not, I'll just give you some examples. Fringe benefits are simply jobs that have a lot of fringe benefits but low wages, which means the fringe benefits are stuff like vacation, stuff like I'll buy you a car, the company gives you a car, the company gives you a house, the company pays for all your vacations. Those are called fringe benefits. So if the company is doing all of that, it's not going to pay you such high wages because it's subsidizing it, in terms of the cars and stuff like that. So I don't know if the correct word was subsidized, but it's probably not. But the company will replace those types of wages in forms of like the fringe benefits, right? And that's probably another reason why the wages could be different. Now, another question to ask yourself is, why do you think wages differ between people in the same job? Because the factors we talked about right now, we said that it could depend per job to job. Of course, some jobs, it's going to differ depending on like the skills you have. But why does wages like differ between people in the same job, right? That's something that you have to also talk about. And the first thing that we're going to be talking about is regional differences in the demand and supply. So I don't know why it's lagging. Oops, sorry. Okay, wow. Okay, there you go. Not sure why it's lagging, but maybe I have to clear it or something. Okay, give me a second. Let me reload this. Okay, it should be fine now. So we'll put... No way. What? Okay. Okay, there you go. I was like, wait, what? Okay, so regional differences in labor and demand. What does this mean? Kind of self-explanatory. So in areas, let's say if I live downtown, in areas like those places where there's more like for that certain type of service, it's going to be a higher wage because for certain areas, maybe cost of living might be more expensive, so I have to probably give higher wages. And that's why a lot of people like complain about the wages, where like a lot of products could be expensive and I'm not getting enough wages, so I have the right to kind of complain that my rent is very expensive here, so of course my wages should be a bit different. The next reason is fringe benefits. Same company, same type of firm, but the fringe benefits example again here. Kind of already explained it so many times, so I'm not going to explain it again and again. The next one could be discrimination, and it's actually a factor that can be counted here. Is that with discrimination, we talk about just the race, the gender, the religion, the age. A lot of discrimination factors could be there when you're doing the same job. Like there's the one where women are paid less than men in jobs. That's a discrimination, and that could be true as well in many firms. That could be, in fact, a factor. The next one is a length of service. So some firms, they provide an extra for workers who have worked in the firm for a longer time, which is actually something that they do, is loyalty. Maybe some companies have some type of programs where if you stay in our program or in our company for this amount of times, you get a benefit. Okay. And then just in general, let's talk about other wage differentials that would involve like gender pay gap. Like, of course, the younger am I, or because I'm more productive, I get paid more. And then skilled, unskilled worker, kind of similar to what we've been talking about, right? So they all kind of revolve around that. Also, another thing to note is something that is the public sector pay gap. So public sector pay gap and private sector pay gap. So public/private, where in fact the public jobs usually have a higher wage rate because that's actually from the government. But that sometimes the public wages can be also low. It depends on the government, I guess, right? So sometimes some government jobs are more paying, sometimes it's less. So it depends on the government, how strong the government is. So it kind of just varies. There's no like one certain thing for any of these factors, in fact, but these are just broad kind of things that you need to have a look at. Let's now finally talk about something called specialization, which comes under workers, and that's why we need to talk about it. And we say that division of labor or specialization. I'm going to be referring it to as specialization. I just don't really get why division of labor, but division of labor just means it's like another part of labor when you further go into labor. So division of labor, what it means is it's basically a concept of dividing the production processes into different stages. So if I have a certain task, I'm going to split it into different stages, and then I'm going to assign workers to each stage of my part. And the reason we do this is because it's going to be more efficient. Because if someone in this stage constantly keeps doing one task again and again, then they will become efficient over time. And in fact, that's even a reason why you get paid more over years, because you get more efficient, you get more experienced. So the same way, if splitting a task into many things will make you be better at that job, will be making you aware of what you're doing, and that's what specialization is, right? So I have a certain task and I'm splitting it again and again. So that's what specialization involves. And now what we need to talk about is the advantage of workers. So here we just say, why do workers have to specialize? What do workers get when they specialize, right? Because they do get a benefit when someone specializes. Now, as I said previously, is that when you do some type of task again and again, you get skilled, you get experienced, and if you constantly keep doing it again and again, workers can get skilled and experienced in specific tasks because they're doing it again and again. And this could be useful because ahead in the future, that could help. Okay. The next one is that there are better future jobs, better future perspectives. And what this means is that like later on, there will be better future job perspectives because of the skill and training they acquire. So if you're doing one type of task again and again, then you will of course get that skill, you get that training, you get that required skill to be better at that certain type of job. And therefore, so that's better future job perspectives. Because of the experience that you gain, you can have of course a better future job perspective. Now with the advantages come the disadvantages, and there are disadvantages with specialization. And the first one would be it becomes very monotonous. And what does monotony mean? So what this simply means is that when you do a certain type of task again and again, you get tired of it, right? Even like manual type labors, that one becomes tedious, that one becomes tiring. And with specialization, what happens is, since you just stick to one task and you keep doing it again and again, it becomes repetitive, and that makes the workers a lower morale. It's like the same thing. It becomes easy, but then you get tired of it again and again. So there is something called monotony. You can get bored of it because you're doing that same boring task again and again, which could kind of make you lose the morale, kind of make you lose the motive. So that's one big disadvantage of specialization. Next is the margin of errors. Even though you do become more efficient, you do get better at this, there is the margin for errors, which means that because you get so repetitive, sometimes a lot of workers do get overconfident, and because it gets repetitive, there's also chances of mistakes. So that's when another disadvantage, and this is more of a disadvantage to the company or to the firm itself, and we're going to be talking about advantages and disadvantages of the firms later, but this is again for the workers as well, because of course if you keep making mistakes, then I don't think you'll be employed into that company more and more. So that is another disadvantage. And then we say something called alienization, and what this means, what this phrase or term means, is basically when you like are just doing confined to just one task, right? If you're just doing one task again and again, what this does is that workers will feel socially alienated, meaning you kind of just doing the same thing again and again, that you kind of get tired of it, right? And that's why manual jobs, maybe that's why people dislike them, is because first of all, many hours of work, and then you're just doing the same task again and again. Okay, so that's what we mean by alienation. Okay, and finally is the very downside of this is that, let's say I keep doing this one task again and again, and let's say in the future that task is not needed. I'm trying to think of an example of this. So let's say so an example of this is, let's say in the back then, like 20 years back, there was a job that you wash cars. Okay, and specialization can work in this, because if you are in a car company, specialization would work where you would just clean the cars, okay, and you just constantly keep doing that job or that certain task. Now the thing is, 20 years down the line, 10 years down the line, there's now machines that do that work. Okay, so now the skill that you acquired by washing cars is kind of gone, right? The skill is gone now, so you have now don't have a necessary skill set. And we saw a factor of what wage differentials are, which skill is such a big thing. Okay, because wages are decided based on skill level. One of the big factors are skill level. So if this certain skill is eliminated, then there is a chance of unemployment, and I'll just put that on the screen right now. So that is an increased chance of unemployment. Of course, that was just an example, but that could be a case, because since you just stuck to one thing again and again, you don't acquire the skills, but rather you stick to one skill. So those are the advantages to the workers, disadvantages to the workers. Now we talk about it in the point of view to the firms. Okay, so we look at the advantages of the firms, we look at the disadvantages to the firms, okay, of why someone would specialize or why a company should specialize. And let's start off with the advantages to the firms, okay? And we'll talk about this one by one again, just like the other one. So when talking about the firms or the firm's point of view, the first, I think, biggest thing is there's going to be increased productivity. Because I do one task again and again, right? Someone or that certain person is going to get good at it, right? They're going to specialize in that particular task. And because they specialize, they are going to make more of that task, right? Or they're going to be more productive, and therefore the output can increase. And always remember, you need to always look at it in terms of firm's perspective. A firm always wants more output. They want the most efficient way, and they want increased quality of these goods. Okay, so when looking at a firm, there's going to be increased productivity in that case. Also, with productivity increasing or efficiency increasing, there is an increased that quality, right? Increased quality of these goods, because not only will it be faster, there's going to be more quality. Again, you can think of it in a way like, let's just leave aside all the firms and all that. If you do a certain task again and again, right? It can be anything, right? If you do that task again and again, then you're going to get better at that, of course. And with getting better at it, you are, of course, becoming more efficient. And this is more, of course, economics terms, but you're getting better at it. You're getting, or in economics, we say you're improving the quality. And when you get efficient with it, right, because you're doing it so many times that you kind of find shortcuts, you kind of find better ways to do something. So that is another way of thinking of it like that. So it's not only just in a firm's perspective, it's for anything. Okay, so that if you want to think of it like that, you can. The next one is the low costs, and workers only need to be trained in the tasks for that. So that becomes very easy for the company to actually manage it, because they only need to teach the workers for that certain task, right? So therefore I need fewer workers. Let's say I have 4 tasks, and let's say I put 1 task for each sector of it. So therefore that means that that's going to be less workers for me, and of course less workers who specialize in that task. So yeah, that's basically that. The next thing we look at is that it's much faster, because when you are, of course, looking at it in terms of the workers, it becomes more faster, because one task to another task, the production is going to speed up. Again, this is kind of linked with the efficiency, because efficiency equals to speed, because once you're efficient, of course, the speed does increase. So that is that. And last but not least, I don't know if this one is a definite one, but it does increase profit, because I have lower cost of production, and increased productivity will, of course, help boost profits. Let's now have a look at the disadvantages to the firms, and there are disadvantages to the firms that come with this. And one of the disadvantages is increased dependency. Okay, for example, let's say that certain worker that is doing a certain task in the company is absent or doesn't come, then the entire production halts, right? It's all dependent on one part of the sector of this. So let's say, if I'm producing something as a whole, and I can explain this through diagrams. If I'm, let's say I'm this is my whole production block, and I've split it into 3 blocks, block 1, block 2, and block 3. So let's say block 1 shuts down. There's a problem with the machine, or there's a problem with some part of block 1. I can then not go to block 2. So block 2 gets halted, block 3 gets halted, the entire production gets halted, which is then, of course, really bad for the company because the production is being halted, output is being lost, and therefore profit is being lost. Because a company is always looking at output in terms of, of course, we're going to learn more about this later, but for now we're just talking about the output, and of course we're dealing with the output. So if something stops in the first stage or the second stage, even if something has a problem in the middle stage, there's basically too much dependency on each sector, on each specific task. The next factor, the next disadvantage is that the danger of overproduction. Okay, because you will not know when to stop, right? Because since, right, it's split up, and you may exceed the demand. So when the supply exceeds the demand, that could be a possibility, right? So that could be excess stock of finished goods, because, like, let's say I'm at stage 2 and suddenly the demand for that certain product has fallen. Now I can't just scrap that good. I have to finish the entire good and then keep that aside. So that's kind of stock. Stock is simply goods that are made and ready to be sold, but not sold yet. It's in the company's hand yet. Okay, so that's what we mean by that, right? And that's what we talk about. Now, the last two things that we need to talk about is in terms of the economy. So if you've noticed, we've talked about the workers. We've talked about advantages and disadvantages to the workers. We had a look at the advantages and disadvantages to the producers. And finally, we had a look at the advantage, or now we are on the economy. Now, when talking about the economy, we are talking about better utilization of human resources. That means that since our workers are doing better at specializing, that means employment rates. Because remember, the economy only cares about stuff like employment rate, stuff like GDP, because that's all it's as long as the economy as a whole. So when we're looking at this, we're looking at employment, right? As long as you're employing these workers for these specific tasks, the economy is good, right? When there's unemployment, that's another problem. Okay, so here there's employment because, of course, workers are doing these set of tasks. The next one is for the economy, there's efficient firms. Now, I talked about something called GDP, and we'll talk about this in chapter 4. But what GDP is right now, what we need to learn about GDP is simply the output. Okay, and that's very important for the country because the country does make a lot of money through the output. Okay, and yeah, that's kind of important. So as you have more output, as the firm is more efficient, okay, then that's more helpful for the economy. I'm kind of not pasting all of these topics. You can always check the notes in the description that I've put, but I'm only putting the ones that are really important. Let's now look at the disadvantages to the economy as a whole, and there's quite a lot of stuff as well to talk about here. When talking about the disadvantages, the first main disadvantage is something called labor immobility. Labor immobility simply means the fact that because a worker can only specialize, because this worker can only specialize on one type of task, they kind of have labor immobility. So let's say suddenly that sort of job thing has now become less in demand, then suddenly, right, they have an immobility, right? They cannot suddenly switch tasks, switch jobs because of that specialization. Another bad thing is it reduces the creative instincts. When someone is monotonous, even though they become more efficient, they kind of lose the creative instincts, and that's kind of bad for the economy. Now, this is kind of more like a long stretch type of disadvantage, but it is, in economics, we do talk about every factor. So this one is a long stretch factor, but it reduces the creative instinct, which means that in the long run, because you're doing the task repeatedly, maybe the previous skills kind of die out. Okay, so long shout, but you could lose the old skills, which is bad for the economy. Okay, so that's it for workers, right? So that's all we talk about in labor in general in this topic. And the next topic is kind of similar to workers, and it's something called trade unions. Yep, trade unions. So we'll now talk about trade unions. We'll talk about what trade unions are, why we have trade unions. Give me a second. We talk about why we have trade unions and what the function of a trade union is in an economy, and it's kind of related with workers. It's like a topic that deals with workers as well. So let me just put trade unions here. Okay, like I do introduce in every topic, we're going to start off by talking about what trade unions is without giving any backstory without giving any definition. What is a trade union? You might have heard of this before, so a lot of this type of stuff you've already heard. I think mostly so far everything we've talked about, you've heard of it in some way or another. Like money, of course, that one is obvious. Workers, that one is obvious. Of course, like wage differentials and stuff, maybe you don't think of that from a day to day, but you kind of know about it. So this one, we talk about trade unions now. And with trade unions, for those people who don't know, trade unions are organizations of workers that are promoting and protecting the interest of their members. So what does that mean? So let's say I'm a worker at a certain firm. A trade union is just kind of helping me out. It's trying to protect me, and it's kind of promoting my work. What does this mean? A trade union pushes for good wage rates. Okay, a trade union pushes for good working conditions, right? Stuff like those stuff that as an individual I can't really fight for, and therefore we create something called trade unions. Okay, that's what trade unions are for. So these trade unions are for the betterment of the workers. Okay, and I think you'll understand more about trade unions when I talk about the functions of trade unions, and I think let's just go straight into that. So let's look at the functions of trade unions. What does a trade union do? I kind of already said it in the definition, but it looks after you, right? It looks after the workers in an economy. And when you look at this, is the first thing a trade union does, it negotiates for non-wage benefits, right? So what is this? Improvements in non-wage benefits. So stuff like working conditions, right? Okay, maybe we'll come to working conditions kind of later, but improvements in the non-wage benefits would be fringe benefits, for example, right? How, have this better done, how have more vacations better, have this done, have that done, right? So that's what the trade union will look like. So not wage benefits, because some stuff you cannot control. Like you cannot be like give a higher pay. You can kind of, but a trade union does not do that. Okay, a trade union does improve the pay, but it also negotiates for non-wage benefits, right? Stuff that does not affect with just straightly to wages. The next thing it does is kind of general, it's kind of common sense, is it defends employees' rights. Okay, so as I said from the definition, I think you do need to know the definition, so I should put the definition here. I'm gonna put the definition, let me just put it here so you guys can all see it. This would be the definition here. Okay, so you can read it out. So trade unions are organizations of workers that aim at promoting and protecting the interest of their members, and they aim on improving wage rates, working conditions, and job related aspects. And now we're looking at the functions basically. Okay, the next function is it improves improving pay and other benefits, right? So this is the big one here, trying to improve my pay, improve my wage rate, and of course other benefits that are tied with this, right? The next one is supporting workers who have been unfairly dismissed, discriminated. We talked about wage differentials. Trade unions can actually fight for them because as an individual, the reason why some stuff you can't fight as an individual, it's better as a trade union, right? So it's better as a lot of workers come collectively and you can actually talk about stuff like this. Now, another thing a trade union does is they do something called industrial actions, which means strikes, overtime ban, and stuff like that. Because sometimes the only way to resolve something would be taking in industrial actions, and therefore many times you can see a lot of workers get on strike, and that's because of a trade union, right? Because as a whole worker, if you go on strike, the output is switched off, and then suddenly they start listening to you. Okay, and that's the reason why many times strikes happen. Okay, now what can trade unions argue for? So they can look for, let's say, for example, if the business, the certain product that they are producing is in demand, they can be like, increase the wage rate, right? Or something like if the output is already a lot, then, give a better pay rate. If the hours are very long, give a pay rate, give a better pay rate. If the prices of the cost of living is rising, then you can say, give a better wage. So those are, how they can argue for a higher wage. Those are the reasons on how they can, right? So those are the things they look at, or better, even working conditions. I don't know if I mentioned it above, but they also look at better working conditions. They improve the working conditions. In fact, that's a big one here, is they improve the working conditions. I don't know where I can put that right there, but somewhere here is they improving the working conditions as better working hours and better safety measures are to be done. Okay. Now, we're just quickly going to discuss, and I'm not going to waste a lot of time here because it's, again, something that you can think about it without even revising this. But let's look at the advantages to the workers. Okay. Let's just leave the notes and stuff. When I look at the advantages to workers, what am I looking at? Okay. Of course, it's better in terms of labor because I'm working together, bargaining power, right? And I'll just paste all the advantages and talk about them right now. And then we'll just talk about them. So of course, we're not going to waste a lot of time talking about each of them in detail. We can just leave it like that, right? So when talking about the advantages to the workers, we say that there's bargaining power. That means always it's better to fight as a group. And so it's better in terms of the labor, right? Because I can make more decisions when I am in a big group. So it's better like that. The next thing is the workers feel a sense of unity and they feel represented. Because if I have a certain group, then it's a sense of unity and it feels represented, right? So there's an increasing morale because I feel like I have kind of some support. For, let's say, if everyone is facing the problem, then I have that kind of support that everyone is feeling this way and there's going to be a change. Okay. Another advantage to the workers is that there's a lesser chance of being discriminated because of this sort of society, of this sort of system. But when coming to the disadvantages is sometimes you can get less wages or not even any wages if I go to strikes, right? Because sometimes if you go on strike, that means the business's outputs stop and they don't earn any profits. So how can they, they pay the wages? So sometimes you cannot also be paid, right? It's not a must. The next thing is we also look at the firms, right? In this topic, we've been looking at the workers, the firms, and the economy in 3 different ways. And we're going to do the same for this. When looking at the firms, what are the advantages of the firms? There's actually advantages to the firm because with the firms now they save time in negotiating, right? They don't have to talk to individual workers and look at each of them. Rather, they just talk about the whole organization and get this. Next, it's good for productivity, right? If they have a certain problem, they fix it. Everyone's motive is high, productivity is high, and that's always good, right? Workers can efficiently organize themselves and things can get better. The disadvantages would come like stuff like strikes, high costs, demands that are unreasonable, demands that you're not able to meet. Like, I want to increase the wage rate, but I cannot, maybe because my business is not being profitable. That could be it could be bad, and it's also a decision may take a long time to make, which could be also bad. And I've kind of talked about all the disadvantages here, but you can have a look at them by pausing the video just now, right here. Okay, so those would be the disadvantages to the firms. And to the economy, when we talk about the economy, we say that it's, as long as it's not it's the trade unions ensures the labor force is not exploited, right? The entire labor force is not exploited, which is always what the economy is kind of looking at, and the interests are being represented. That's what the economy does as a whole. However, there are disadvantages to the economy, stuff like unemployment, less competitive in the international market. So what that means is that, for example, if there's unemployment, there's a strike, right? The output stopped. There's going to be an impact on the total output of the economy, which is bad. And even though it's like small for, of course, per business, it still matters. Okay, so we talk about stuff like that. Okay, so that's kind of it about trade unions. It's not that big of a topic. It's kind of a small topic that we talk about within this. Okay, now let's talk about the firms. Let's talk about firms next. And so this is 3.5. Let's talk about firms. And within firms here, we're going to be talking about, like, first of all, the classification of firms, and then we'll go on from there. So firms are classified into 3 separate categories that we look at, okay? And the 3 categories that we're going to be looking at is the primary, the secondary, and the tertiary. Okay, so we're going to look at each 3 of these 3. Okay, so firms, they're split into these 3. Again, the concept of splitting. Okay, we've gone over that couple of times. Okay, so let's start off with primary, and you might know this from geography. If you've done geography, like high school level geography, you might know this from there. But primary sectors, or they call sectors, or they're just called categories. But primary sector, or the primary category, deals with all the economic activity involving the extraction of raw materials. Okay, so anything that deals with getting the raw materials from the start is what we call the primary sector. The secondary sector is dealing with all producing the final or the finished goods. So at this stage, it's currently semi-finished, but we are producing these final goods. And finally, tertiary is offering intangible goods, offering services, right? Offering like jobs, banking, services, transport, anything like that. That is tertiary. Okay, so firms are divided into these three categories that we need to have a look at. Okay, so those are the three categories, and that's kind of the introduction to firms, right? A firm can be either in the primary sector, into the secondary sector, or into the tertiary sector. Okay, so that's how we introduce this topic. Further, you need to also know that there's two types of firms as well. That is the public sector and the private sector. Okay, and you might have heard of these types of terms. But a public sector is owned by the government, and we did talk about this when we were looking at public jobs. So we talk about basically public goods. Those are all associated or tied with the government. And then private goods are tied with basically private individuals. So individual firms, right? So these are within firms, we have two types of things. So you need to know if it's a public firm or a private firm. And we basically look at these two as well. Okay, so it's very important to get at least these like basic 5 concepts onto firms, and we're going to be using these 5 terminologies throughout the topic. So that's the reason why we introduced them in the start. Okay, so primary, secondary, tertiary, you know this from geography. If you've done geography, you should know this. And then we have the public and private, and yeah. Okay, so whatever involves with the public sector and the private sector, that's what we talk about. Now, under firms, the first topic that we're going to be talking about is something called small firms. Basically, a small firm is a firm that is just independently owned. So we're going to start off with that one right here. So I'm going to paste it here, and we're going to start off with small firms. What are small firms, right? And we're going to start off with this, and then move on this topic and progress after that. Okay, so we're going to start off with the definition of what a small firm is. A small firm is an independently owned and operated enterprise that is limited in size and in revenue, depending on the industry. So that is the definition of small firms. We'll start off with the definition, right? So a small firm is an independently owned and operated enterprise that is limited in size and in revenue. That is what we mean by a small firm. Okay, so when we're talking about small firms, they are individually owned. So what are some characteristics of these? Okay, first of all, they have less capital. Okay, that means that the initial start of these types of firms have less capital. They also have a less workforce. Okay, they have a less workforce, and also they require less machinery. These are kind of just like some features that are involved within small firms, just to understand what small firms are as a whole. Okay, so small firms are individually owned, independently owned. What does it mean by individually owned? That could mean it's owned by a family friend, it's owned by you, it's owned by just a small group of people, right? And that's what a small firm is. A small firm is not using that much capital. It doesn't have a lot of people working in the company, maybe just 1 or 2. And there's no that much machinery. There's less capital involved. Capital is kind of even like machinery. But in general, there's less of all of that. And that's what makes up a small firm. Okay, so in this topic, we kind of introduce with small firms and talk about the characteristics of small firms and stuff. And let's now start off with advantages of small businesses, because we do have advantages with this small business. So what are the advantages of having a small business? And in fact, there are advantages, and later on we'll talk about like bigger businesses, more stuff with that. But let's start off with the advantages of small businesses. And the first advantage that we say is that there is independence. Okay, what does that mean? Okay, now in the definition we said that these are independently owned, so kind of like borrowing from that context. Independence, what that means is when it's independent, the owner, who is of course who owns it, are free to run the business as he or she pleases. He does not have to follow commands from anyone, unlike if you are in another business, right? If the owner decides I want to increase my output, then I can, right? If the owner does not want to increase the output, he cannot. Okay, so with the advantage of small businesses, there is that sort of independence that you have with that. Okay, the next advantage is sort of control, which is kind of similar to this, but we have a sense of control. Okay, we have a sense of control. If I could zoom out, yeah, there you go. So sense of control. There's control within this business or this company because or this firm, because the owner has full control over the business. So he makes decisions like whether I want to get workers, whether I want to change my do this with the product, do that with the product, do I want, how many branches should I have, or not even branches, but like unlike large businesses, it's so much harder to control them because they have a lot of people, first of all, running it. They have a lot of branches running it. So it becomes very difficult to control it as a whole. But when it's a small firm, which kind of makes sense, small firm, easier to have control. The next advantage that we look at is flexibility. And when we talk about flexibility, again, it's kind of just similar to all of like what the owner can do. Once there's one single owner, there's kind of flexibility. And throughout this topic, the reason why I kind of don't like teaching this topic is because a lot of it is self-explanatory. Like flexibility, there's one owner and he can do anything he wants to, right? He can quickly change as the owner is more involved in decision making. He can make whatever he wants to do, right? There's flexibility. Then there's the better communication. So better communication, again, kind of similar. They all tie to each other kind of because when you have control, you have flexibility. When you have control, you have better communication. When you have independence, you have better communication, flexibility, control, everything kind of tied off with each other. Did I speak very fast there? Anyway, better communication. So since there are fewer employees, stuff can be regulated within each other very easily and quickly. Okay, so those are, and finally the last one is innovation. Innovation meaning, again, I'm only one owner and they take only, my decision. So depending on the owner, if he's innovative, then, there's more that you can innovate because there's less to lose because you don't have that much at stake compared to like bigger businesses. They have more competition, this, that. Smaller businesses do have competition, and we'll see that in the disadvantages. But there's more innovation, there's more room to improvement, basically, because they are smaller firms. Okay, let's now have a look at the disadvantages of small businesses. And this kind of, in this topic, we kind of just jumped into like all the advantage, disadvantage, and you might feel like that, but that's actually how this entire subtopic has been taught. Like you just straight away go to small firms, this, that, therefore. Okay, so disadvantages of small businesses, and the first one is that there's going to be higher costs. And what does this mean? High cost meaning, of course, I'm a small firm and I am handling everything. So all the money that's coming out to the business is all from my pocket. So, and first of all, I cannot exploit economies of scale. And this is very important. We will talk about this just later on this video. But economies of scale is very important. And we cannot take use of that. And maybe this point might make more sense once we talk about economies of scale. But economies of scale is simply, if I can quickly define, is that if I'm a big company and I buy something in bulk, I'm getting economies of scale because I'm getting a profit if I buy in bulk. But when I'm a small company, I can't buy that many products because I'm just a small company, right? So I don't get that benefit of bulk buying. That's just one example of economies of scale. There's a couple of examples like, when you get financing from banks and so on and so forth. So there is higher costs because I'm smaller. Another disadvantage, is that there is lack of finance because, first of all, I am the only one, or the owner is the only one who funds the business. So, of course, there's going to be a kind of like a small choice of sources for acquiring finance because taking loans and stuff is very difficult for small firms. They rather give it to firms that are bigger, and so it's all usually from the owner. So it's difficult to get the finance, difficult to get sources of finance. And then next is it's difficult to attract experienced employees. Like think about it yourself, right? If I'm an employer and let's say I want to work in a tech business, would I want to work for a small tech business or for like Google, Facebook? Think of it like that. Of course, because bigger businesses can pay more to employees. And of course, skilled workers always want to go to places where they can use their skills rather than a small firm. And then last but not least, a disadvantage is something called vulnerability, which means that when there are like a big businesses around you, it's very difficult for a small business to actually work because they lack the resources like bulk buying, this, that, advertising. They it's very difficult to survive in an economy where there's a lot of like large businesses. So there's a sort of like vulnerability, okay, that comes with that. So those are the advantages and disadvantages that you need to have a look at for firms. But regardless, we still have small firms in this economy, and what's the reason to why we have small firms? And it kind of ties up to the advantages, but there's some other several reasons to why we still have small firms. And the first one is the size of market, right? The size of market. Size of market is the first kind of like topic that we talk about. So size of market, when we're talking about size of market, why do small firms exist? First reason is size of market. And let me explain this point. So when there's a small market for some certain product, okay, and my firm is doing that product, then I'm gonna continue doing it. For example, in YouTube, there's a very few teachers who are teaching economics. So therefore, when I teach economics, I'm a small firm. A lot of students are still getting my product from watching my videos because it's a small market, right? So I'm still gonna, of course, make stuff. Okay, and then eventually you can get into a bigger business, hopefully. So hit that subscribe button. Anyway, I don't usually ask my students to hit it, but if it does help you, please do. Okay, thank you. The next one is the access to capital is limited. Okay, so what does that mean is owners can't grow the firm, right? In a way like that. And some owners would prefer to actually stay small, right? Because they don't want to take risks. They just want to get the profits, move on, day-to-day stuff like that, right? And last but not least is the governments actually help small firms. Okay, so that's the thing, that governments actually help small firms. So these governments help small firms. They do give subsidies. Why do they do this? This is because it gives employment, right? It gives employment. Okay, and also it's not that expensive to subsidize these types of goods. And when you think of it like that, oh, it's just one small firm. When you think of so many small firms, that's when like it actually can contribute to employment. Okay, so those are the reasons why small firms still exist in an economy. So that's kind of it about small firms, right? There's not much to talk about, and it's just revolving mainly about like the advantages being, I have one single owner. What can one single owner do? And the disadvantages come from the fact that it's difficult to survive in a place where it's like, because of the large businesses and stuff like that, it's difficult to survive in that way. So yeah, so those are the disadvantages kind of that you have to look at for small firms. And yeah, I mean, that's kind of it for that. And now we move on to this topic called growth of firms, where if I'm a small firm and I'm kind of growing, it's kind of not related, but the growth of firms deals with scale of production increases. Okay, so firms can grow in different ways, and I think that's the reason why we kind of introduced small firms first. So we talk about that first. Okay, so let's now introduce the growth of firms. Let's introduce growth of firms. Okay, growth of firms. Let's start with this one. Okay, so when a firm grows, its scale of production increases, right? Of course, we know that, right? So as we grow, right? First of all, a firm can grow in two ways, right? The first way is internally. Okay, so internally. And the second way is externally. Okay, and I'll explain what both means, internally and external. Okay, so we'll start off with internal growth. Internal growth involves expanding the scale of production of the firm's existing operations. Okay, so I'm just going to summarize it in that much. That internal growth involves just expanding the scale of production of the firm's existing operations. So if I'm doing an operation that I'm already doing, I'm just expanding that scale of production. External growth is kind of different. Okay, and this is when I sort of form, or two or more firms join together. Okay, and later on we call this something called merging. Okay, and it's basically when two or more firms are joining together externally, and that's why it's called externally, just to become one bigger unit. Okay, now we're gonna deep dive, or kind of dive more into this, by why people merge and how people merge and the different types of merging. And we're gonna start off with now this type of merging that I just explained is actually called integration merging, but we'll look at that later. Okay, now to externally grow, there's two types of methods that you can do. Either one is to merge, which is the more popular one, and the second one is take over, right? Those are the two ways that you can grow externally, right? So there's internal growth, external growth that we've talked about. Now let's kind of talk about, so now takeover is simply when one company just buys the other company's shares and takes full control of the other company, so they simply take over. But when we talk about merging, it's kind of more complicated. And now we study more about what merging is, why merging is, the different types of merging that a company can actually do. Okay, so let's now put our focus on merging, and let's start off with what a merger is. What is merging, or what is a merger? The first thing that comes to mind when you're merging is just joining, right? So the meaning, join. So a merger occurs when the owners of two or more companies agree to join together and they form a firm. So if there's company A and there's company B, they mutually agree, it becomes AB. I've used some maths here, but these two merge together and they become one big company. But why do we merge? Right? And that's what we're going to be discussing in this part of the video. Okay, that is why you are here and that is why you're in this video. Now, mergers can happen in three ways. Okay, and we're going to discuss all the three ways that can actually happen. And the first way is the horizontal integration. Okay, and so the first one is called horizontal integration. Don't be scared, it's not maths, it's horizontal integration. Okay, I don't know if you have actually learned integration yet, so you might not know what I'm saying right now. Okay, you probably don't, because I think integration comes in A levels. Okay, if you're in, okay, 1 year later you'll remember, okay, this will be funny because I don't know, man. Ugh, okay, let's go back to economics. Okay, so the first type of merging is horizontal integration. Okay, and let me try to explain what this means. Now, I'm gonna try to explain it. Of course, there's you have your notes besides you, so there's no really point of kind of copy pasting the notes always again and again. I'm just kind of explaining, and you have to memorize all these definitions. So go to the notes and then memorize them. But for now, I'm just gonna try to explain everything because that's what the purpose of this video is, right? It's not trying to make you memorize anything. Okay, so horizontal integrations, what does it mean? So when there is a company A, okay, and this company A is producing clothings, and there's another company B and they are also producing clothings. Okay, so horizontal integration involves when two firms that are producing the same type of production or are engaged in the same type of good at the same level of production. Let's say they both are at the secondary, or let's say they both are at the secondary stage where they are making the clothes and they decide to merge. That is called horizontal integration. Okay, that's the first type of merging. And now let's have a look at the advantages and let's have a look at the disadvantages. And I'm just going to kind of paste this entire thing in this page so that we can just get it done with. Okay, here it is. Okay, so we'll start off with the advantages. And the advantages is that it exploits something called the internal economies of scale. Internal economies of scale, we kind of just said here, is that includes bulk buying and technical economies and financial economies. Right now you won't understand this because later on after we finish this, we will actually talk about it, internal economies of scale. So this will just make sense. Give me around 10 minutes. We're going to come to that. The next advantage is that save costs. Okay, so when merging, a lot of the duplicate assets, including the employees, can be laid off, right? So a lot of people, let's say I have one manager now. If we have two managers, I only need one manager, so one manager goes, right? So it saves costs. I don't have to pay for two managers now. Okay, then there's something called revenue synergies, okay, which means that there is a potential to secure this by creating and selling a wider range of products from the same two companies. And then, of course, you reduce competition because you're kind of removing another competitor. And then with the disadvantages is the risk of diseconomies of scale. So we'll come to that again, which means that a larger business will bring with a lot of managerial and operational issues. That means that if it's a bigger company, it's harder to manage. It's kind of the disadvantages of small firms, right? Difficult to manage and stuff like that, right? And then reduced flexibility, which is another disadvantage. So in the other one, there was more control, more flexibility. All that is gone now, right? So it's kind of the advantages of the firms is now the disadvantages of this type of thing. Okay, let's now Let's now go to the next type of merging, which is vertical integration. Okay, So now let's talk about vertical integration. Okay, so with vertical integration, what we mean by this is, now I'm going to try to explain it again. So let's say it's the same type of good but different levels of production. So let's say I have A, they are getting the cotton for clothes. And then there's B, which is making the clothes. So these are two different companies, company A and company B. When I merge these two companies, this one is kind of in the primary, right? This one is kind of in the primary sector, and this one is kind of in the secondary sector. So when I merge these two types of goods, we say they did vertical integration. So horizontal is same level of production, vertical is different level of production, but same type of good. Okay, and the advantages and disadvantages, let's have a look at that. The advantages is, first of all, let's say I merge with someone who is selling clothes. So person who is making clothes can benefit from that. Another one is like, also if I merge with someone, it can prevent like firms from supplying materials or selling products to other competitors. So if, let's say, I keep getting all my cotton from this clothes, he will not like kind of supply to other companies, so that kind of just eliminates competitors. There's disadvantages as well. Risk of diseconomies of scale. Anytime there's a big like kind of company, there's always a diseconomies of scale because it's harder to operate. Kind of the same thing that we talked about, reduced flexibility. It's the same disadvantages we just talked about above, so kind of use the same things. Okay, and the last type of merging is a merging called lateral integration or conglomerate. Have I said that right? I don't know. So lateral integration. So this occurs when the firms are producing different type of product and they are at different level stages. So let's say A is they're producing Coke, B they're producing Pepsi. They merge, and whatever product they form is actually called merging. The advantage is that they're kind of diversify the risks, okay, which means that they spread their risks because they're kind of in two markets but at the same time in one market, right? Because they're kind of producing two goods, so it could either backfire, like maybe Coke does really well, Pepsi does really bad, they still profit, right? So that's the advantage. Second, it creates new markets. When you merge these types of things, I'm creating a new market. Thirdly, another advantage is the transfer of ideas. Now, again, I'm kind of like skimming through all the advantages, but I want you to go to the website down that I've put below, and I kind of like cram all of this because right now I'm just trying to explain. That's kind of the main purpose. Okay, so transfer of ideas means that maybe this company does this better for Pepsi, then I imply it for Coke, and then it also becomes effective and they both do well, and that's kind of advantages. With disadvantages, it's stuff like, again, diseconomies of scale or inexperience can lead to mismanagement. Let's say something Pepsi has been doing, Coke doesn't want to do now, that could kind of be a cultural clash. That means that if I am doing something in this, then these people don't want to do this. So that's called a cultural clash. And then they could lose focus. For example, if you're kind of putting your eggs in many baskets, right? Or I don't know, there's some quote like that. But if you're kind of losing the focus of the core product, then that's going to be a problem as well. Because even like on YouTube, as a YouTuber, I'm kind of, I can talk about YouTube. So when you upload videos of like, let's say I upload videos of SAT, no one's going to watch those videos, right? Because I have to stick to the niche I am, right? I have to stick to the videos I have. So that's actually how I need to stick to certain types of videos. Okay, so that's kind of the three types of merging that you need to have a look at. Those are the three types of merging, and that is all you need to have a look at. Okay, now we move on and we talk about something called scale of production. Okay, so that means that as a firm's scale of production increases, which means as a firm grows, then they're going to have a scale of production. And it's a small topic, but we kind of have to discuss it as well. Okay, so this is where we talk about economies of scale. Okay, now my thing is frozen again, so okay, never mind. Okay, so now here we talk about scale of production. Okay, here it is. Okay, scale of production. So when we're talking about scale of production, we talk about something called internal economies of scale. And I kind of said I'm going to talk about this right now. So internal economies of scale are simply decisions that a firm takes because that can bring advantage to the economies. Okay, so it's decisions I take that benefits the economy. And I'm going to go over each of them one by one. The first one is purchasing economies, and you might not know what this means, but purchasing economies simply means that when large firms buy raw materials in bulk, right, that increases the scale of production, and that means the supplier can give them at a cheaper price. So we say this is called purchasing economies. The next one is marketing economies, right? So marketing. Now, marketing economies simply means that when large firms can afford their own vehicles, they can, kind of do their own type of distribution of them, right? The cost of production or cost of advertising is spread, right? Because it's a big company, right? They can start doing their own type of billboards and so on and so forth. This is called market economies. And because I advertise, that's going to increase the output in the large firms compared to small firms. And in overall, all this is kind of helping the economy. Let's go to the next one, financial economies. Financial economies is when we kind of involve the bank, right? So financial economies. So financial economies is something like banks are more willing to lend money to these types of people because they have a more secure financial position where they can repay the loans, can pay also the loans. We then have something called the technical economies. Now you need to, of course, go back to the notes, cram all these stuff I'm talking about. Technical economies simply means that because I'm a large firm, I can produce good technology. Good technology means I can produce very good output, very good like goods, quality goods, fast, efficient. And the last one is the risk-bearing economies. Risk-bearing economies. Coming from its name, I am a bigger firm, so I can take more risks, right? I can start introducing maybe new types of products, try to test the market, and nothing is going to really kind of affect me because of how much high output I have, that it kind of doesn't affect if I'm kind of experimenting on the side. So these are basically the internal economies of scale, and they are the benefits of being large. In other ways, just benefits of being large. These are the benefits of being large. Okay, now, economies of scale. I think that's pretty much it that I wanted to talk about in firms. And now we move on to, I think, something kind of small here. And so now you've noticed that I'm going to be skipping firms in production. The reason why I'm skipping firms in production is because I've already kind of talked about this very, very deeply in all the other topics. Because in this topic, we talk about stuff like how productivity increases, what are the factors that involve production and stuff like that. Okay, now this type of stuff we've already talked about in like specialization, where I talked about productivity, efficiency. The more I do something, the more I better. Okay, so I want you to look at the notes for firms in production. I'm not going to waste time in this video and talk about kind of that right now. But however, I want to talk about this topic right here, which is firms, costs, revenue, and objectives. Okay, and in this, I'm kind of just going to be introducing some graphs that you need to know and some calculations that you need to know. That's kind of it for this sort of topic. And there's a lot of like extra information in the notes that you can have a look at, and like objective of firms and stuff. We'll have a look at that right now. So first of all, we need to look at what fixed costs are. Okay, fixed costs are costs that are fixed in the short term running of a business. Okay, for example, bank loans, telephone bills, right? These costs do not depend on how much output is produced. Okay, for example, if I have rent, regardless of how much output, regardless of how much profit I have, it's going to be fixed. Okay, so this is called fixed cost curve. Okay, and then we have something that you need to know is how to calculate average fixed cost. You need to know how to do that. So average fixed cost is simply total fixed cost over total output. Kind of cram this. We then have something called variable costs. Variable costs are costs in the short-term running of the business that are paid according to the output produced. For example, electricity bill, wages, cost of raw materials. Let's say my product is suddenly in high demand, then I'm going to produce more of that, so I'm going to buy more raw materials. So the cost of those raw materials are actually called variable costs. Okay, now to calculate a variable cost, average variable cost, I'm going to be using this formula right here. Average variable cost is total variable cost over divided by total output, kind of similar to fixed cost. Okay, now the last one is total costs. Okay, total cost is equals to total fixed cost plus total variable cost. Kind of just that's it, right? So those are the things that I wanted to kind of talk about, and just very important to talk about when talking about just firms. Okay, last but not least, I want to kind of talk about revenue and what does revenue mean. Okay, and I'm kind of going a bit fast here because there's not really a lot to talk about here, but rather just look at the notes and there's some examples that you can have a look at on the calculations of this. But revenue. What is revenue? And you need to know this definition. Revenue is the total income of the firm earns from selling its goods and services. And you need to know what total revenue is, and total revenue is the number of units sold times the price per unit. It's kind of like basic maths. So that's the reason why, I'm kind of skimming through this. Okay. Now, last but not least, I need to look at the objectives of firms. And the objectives of firms, I'm going to quickly go over them. The first one is survival. As a firm, I want to survive. As a firm, I want to be within the market. That's kind of it, right? 2, profit. I want to be profitable. As a firm, I want to profit, right? So that I can make further investments, I can have a payment of return, and I can maximize my profits by expanding, basically, okay? 2, I want to grow. 3, I want to have growth. Every firm wants to grow. So I want to grow so that I can have a greater job security, have a better salary for my workers, and have the benefits of market, or have the benefits of economies of scale. Okay, 4 is market share. Market share meaning that I want to have a proportion of the sales in the market achieved by this business. So when I have an increased market share, that means a lot of benefit comes to me. For example, customer loyalty, brand image, stuff like that. And the last one that we talk about, the fifth one, is service to society. So these are the business objectives or firm objectives. So service to society is some operations in private sectors do not aim just for profits, right? They want to maybe make the society in a better way. So these are the 5 objectives of a firm that you need to remember, and these are why probably firms, or these are the objectives of just firms, why, firms have that. Now, before I end this video, I want to just talk about one last thing, which is what a monopoly is. And a monopoly is simply a business. I don't know if I've said this before. I think I have. A monopoly is simply a business that dominates in the market because they are the only single seller. Okay? And that's kind of it that I want to talk about monopoly. Now, throughout the end of the video, I kind of rushed. Okay? And the reason to this is because a lot of it is talked about already. But I want you to go over the notes, look at the kind of the last chapters and read through it, look at the different formulas and stuff. And with that being said, thank you guys for watching this video, and I'll see you in chapter 4. Goodbye.